Okay, I just want to go over briefly one of the trades that I took last week. Well, this is the Euro Aussie, and basically what I'm doing, I use two time frames. I use the daily and the 4 hour time frame. I only use the daily and I only use the 4 hour. Basically what I'm doing is taking the daily just to determine what direction price might be moving in, and then I'll flip over to the 4 hour to give me an entry points and exit points on the 4 hour. So we're looking at the daily here. You see I have a 6 period moving average. That's my fast moving MA. And then I have a slow MA, which is 150 period moving average. I'm basically looking for an indication of trend direction from the daily. I also have a supporting indicator here. This is called the FOSI. It's basically an RSI. The blue line is the RSI. The red line is actually the moving average of the RSI. And I really like this indicator for extremes. When it's in the upper range or lower range and that moving average is crossing the blue line. It's a fairly reliable indicator as far as that goes. I like using the RSI for the extremes. Let me flip over to well, you can see here on the daily, you can also see that this is definitely weakening in price and has been for some time. These lines here, the green lines, are my entry points into the trade. The red line here is my exit out of the trade. And let me kind of go over how I did that. I use a breakout system. This is the Donchian channels, very simple, highs and lows. And I got into the trade on this day. This was August 31st. And as you can see here, you can barely see the gray Donchian channel line moving across there. And this green line was my initial entry. That was the breakout of that Donchian channel. I use sell stops and buy stops a lot, so I don't really like to sit in front of the screen too much, and I use the sell stops and buy stops to get me into and out of the trades when I can. And I base my stops on the average true range, or the ATR, off of the 4 hour. So you can see that right here. The ATR for this pair is 43 pips roughly. So what I typically do is scale into the trade. A lot of traders don't, or a lot of traders will take partial profits. I don't believe in doing this. I think you're really shooting yourself in the foot when you take partial profits, because if you place a stop and you put your lots on and you get stopped out, you will always get stopped out of the full size. You always get stopped out of all of your lots at the same time. But if a lot of traders, as soon as they have a profit, they start taking money off the table. So they'll never see the trade mature to the end with all of their lots in play. In other words, with all of the leverage, they'll never see that take place, because they'll always be taking some of the lots off the table. So what I do is just the opposite. I scale into the trade, and as you can see here, each line is I trade 2 lots per trade, and each line is me scaling into the trade. So initially in at 134.80, right there at the break of the Donchian channel. This was a sell stop. The initial stop was put back here right around 50 pips or so. I usually use a 1 to 1.5 ATR. Okay, and I try to use some common sense too. I try to find a support resistance point or a round number or something like that. But each time the price advances by the ATR, 40 pips or more, I'm going to scale in and put on another 2 lots. So here the price advanced throughout 50 pips, and I went into another 2 lots. As soon as I shorted another 2 lots. As soon as I did that, I took the initial trade and moved the stop down to break even. By doing this and moving the stops in such a way, I'm only risking a certain percentage of the account. I try to take on no more than 1 to 1.5% total risk. So even though I'm playing multiple lots, because I continue to move the stop to the break-even points, I'm only taking on a loss of the risk of the most recent trade that I've placed on. So even in this particular trade, I'm playing 6 lots total, but I'm moving the stops to each subsequent trade. I'm moving the stops to break even and I'm only taking on the risk of the last trade that I've actually done. And eventually when that advances, when you see here the third lot that I put on, or the third unit that I put on, which would make a total of 6 lots altogether, it'd be 2, 4, and 6. And as soon as that price has advanced, whatever the ATR is, and you see I have moved the stop down here, which is about 60 pips. As soon as it has advanced to that level, I have moved all 3 of my stops down to 1 stop level, locking in the profits for all 3. So I guess my point is with this is that I'm compounding my profits by adding to my adding lots to my trade as the price advances, but I'm only taking on a small amount of risk because I move my stops down each time to a break-even point. So I'm letting my profits really work for me while only taking on a small amount of risk. That way, I'm assured of a small loss if the trade goes against me, rather than putting all 6 lots on altogether and worrying about getting stopped out of that. I can place 6 lots and only take on a small amount of risk per lot. And if it goes in my direction, which this did, I think what is this, about 160 pips, something like that. So if I measure down to where I got stopped out, and I got stopped out of this, that's about 150 pips. Okay, a chart move of about 150 pips, but because I have 6 lots on at varying places, that works out to be somewhere around 660 some pips total per lot. So yeah, by compounding my trade, I've taken a 150 pip move and turned it into something like 600 and something pips, and only taking on about a 1% risk in doing so. And I'm basically just using a breakout system. I'm compounding my trades. I'm being smart by moving my stops along with the trades, and I'm using the average true range to set my stops and place my trades. So this is just a method that has been working well for me. I had the best week I ever had last week, and I think that it'll work for you. But anyway, that was my Euro Aussie trade.